All right, so let us continue from where we stopped from. So let us look at inventory valuation methods. So this is not a new thing to us. We have covered this before. So the methods that are there, we have FIFO, which is first in, first out, LIFO, last in, first out, weighted average, also known as AVIGO, next in, first out, FIFO, and standard cost. So far we have been able to cover these in our prior modules, right? C for accounting 2. But these two are new. But this course doesn't really focus on these two, right? We'll just have to explain so that you just know the idea. We'll still focus on the three. So this whole lesson won't be as new. So it will be more of a revision. So that's how it's going to be. So I'll start with the new two methods. Then I'll go to the ones that we're already familiar with and do some practice questions so that we can remind ourselves of how to apply the principles. So the first one, the next in, first out, NIFO. What it actually says is like it involves one making estimates of the next order price for each issue, right? So you're saying whenever you want to issue an item or sell an item, the value that you're attaching to it is the estimate of the next order. So the advantage of this, so let me just give an example. If you actually bought this at 50 kwacha, right? But you want to sell them now, you want to issue them, right? Maybe the estimate is 51 kwacha. That means you are going to value this cost of production at 51 kwacha rather than at the amount that you paid for, right? You might have bought it at maybe 40 kwacha, something like that, but you have to estimate what is the next order. So what this method actually gives an advantage that you are gonna produce realistic cost of production. At the same time, you're gonna produce realistic inventory value, because what you're saying is your figure that you have used to actually cost or value your inventory will be closer to the current market. Will be closer to the current market. So that's the advantage, that you produce realistic production cost and inventory valuation. While the disadvantage is that to come up with the estimate, it is a complex activity to do. So it's not as easy as you think just to estimate the next order. So the advantage is that you're able to come up with realistic cost of production or cost of sales and inventory valuation. While the disadvantage is that it is hard to come up with accurate estimates. So looking at the standard cost is all about valuing your inventory and cost of production at a standard cost. So what is the standard cost? So when we're talking about the standard cost, we're talking about a cost, a predetermined cost, a predetermined cost. So when you're talking about pre, it's something to do with in advance. So what you are saying, a predetermined cost is a cost determined in advance. In advance of what? In advance of the actual incurrence of cost. So before I actually incur the actual cost, right, I'm gonna use the cost that I actually determined. So what happens if the actual cost and the standard cost differ, right? So when these two differ, the difference will be treated as variance, right? The difference will be treated as variance, and this will be shown in our reports, right? This would be treated as variance. So I won't focus much of my attention on this because we have a full topic on this standard cost. We have a full topic on standard cost, and we have a full topic on variance. So we'll talk about this in detail when we come to look at those. So let us look at FIFO. Right, FIFO, it's all about saying that the first goods to be sold or to be issued will be the first that were purchased. This theory is based on a realistic thing. For example, you buy bread, right? You buy bread 3 weeks ago, let's just say you buy bread last week Friday. No, let's break Monday. Let me just say you buy bread on Monday, right? 100. You buy on Tuesday, 200, 20. On Wednesday, you want to issue. In real sense, a normal person will start to sell the bread that he bought on what? On Monday. Because what you're saying is, if you are gonna leave it unsold, it will start to lose its quality. So this method is based on this what theory that you want to sell the things that you acquired long time ago rather than the ones that you have just recently bought. So this means that our closing inventory will be formed by the goods that were purchased last. So we're saying that if this is our shelf, so these are the items that you bought first, then this second, this third. If you are to issue, right, you first issue these ones first. So if you have to issue the second one and the year end has come, your closing inventory will be formed by those that were purchased last. So that's what it means. So let us try to illustrate this using an example. So let us have this example saying that on 1 January 20X1, Mr. G started a business buying and selling a special yarn. He invested 400,000 in the business, and during the next 6 months, the following transaction occurred. So this is what occurred in the next 6 months. The yarn is stored in a rented premises, and the closing inventory of the yarn counted on June 30 was 500 boxes. Other expenses incurred and paid in cash during the 6 months amounted to 23,000. So this is what is happening. So for us to come up with the requirement is to come up with a stock ledger showing the value of issue during the 6 month period and the value of closing at the end of June, using the different method LIFO, FIFO, and weighted average, and set the advantage and disadvantage. So we start with FIFO. So we'll have to come up with our table. So the table has to look like this. We have our date column, our receipt column, our issue column, and our balance column. So under our receipt column, we also have 3 columns. So the first column is quantity, unit price, value. Same applies to the next 2 columns of issue and balance. So this is how it should look like. So now we will start. So we'll start with the first transaction. So the first transaction is happening on 13 January. 13 January, what is happening is they are actually buying 200 boxes, right? 200 boxes at a value of 72,000. So we're saying that on 13 January rather, 13 January, what they're buying 200 boxes at a value of 72. So what is the unit price? So for us to find the unit price, we're going to say 72,000 over the quantity, which is 200. So the answer will be 360. Because on the same date, there is no issue, there will be dashes here, and this will go to our balance. It will be 200, and the value being, the unit price being 360, the value being 72,000. So we can close for that date. We can close for that date. The next transaction is also happening on February. They also purchased another bunch or another consignment, 400 at 152,000. So they bought on 8th February, they actually bought 400, right, at 152. If we were to find the unit price is 152,000 over 400, which is 380. On the same date, they did not do any issue. That means now our balance will be the 200 that was in the stores at a value of 360, which is 72. And the one that we have just bought recently, 400 at 380, that's 152. So we'll find the total balance being 224,000. And here we'll find 600 boxes. So we'll close that one. We'll go to the next, right? The next is 10th February. 10th February, they actually now sold or issued, right? So for us to value, we're going to value this at cost and not using the selling price. We don't use the selling price. So don't think that we are going to use the selling price when we are doing all issues. No, we are going to use the cost, right? So we know that there are 500 units that were sold. So there are 500 units that were sold on the 10th of February. So we're saying the 10th of February, there was no issue, there was no receipt, but there was an issue of 500. Is it 500, right? But because this is first in, first out, we are gonna first issue the ones that were issued first. No, were received first. So the 200 will start to go out. The 300 will come from the 400 here. So it's gonna be 300. That means it will, the 200 will be cost at 360. Wow, this one will be valued at 380. That's how we do it. So together we'll find the 500 that was issued. So here we should find 72,000, and the other we should find 114,000. So together we're finding 186. 106. That means the balance right now, there's only 100 that are remaining. 100 in the 400. So it's 38,000. So we can just say, now the balance is 100 boxes at 38. We can close for that date. So we will go to the next, right? The next date is basically on the 11th of March. On the 11th of March, they actually purchased 600 boxes at 240. So we're saying on the 11th March, 600 boxes at 240, the unit price will be 400. That's 240,000 divided by 600. There's no issue on that date. That means our balance will be the 100 that is there already at 380, which is 38,000, and the new consignment, which is 600 at 400, which is 240. The total balance will be 278,000, and the boxes will be 700. We can close for that date. So let's continue and go to the next date. The next date will be on the 12th of April. They bought another consignment of 400 boxes at 140. So we're saying on the 12th of April, 400 boxes at 140,000. If we divide, we find 350. So there's no issue on the same day. That means the balance is 100, then 600, then the new consignment of 400. Together, the balances of boxes will be 1.1. That means the 100 will be valued at 380. This one will be at 400, and this one will be at 350. So we have 38,000. We have 240,000. Then we have 140,000. So together we'll find 418,000. That's the balance. So that's the current balance. We'll have to close it there. Then we'll go to the next date. The next date is on the 20th April. That means they sold 600. I said you never use the values of the selling price. No, we use the cost. So we're going to say 600, right, is the one that was being sold, right? So we know on 20th April, we have nothing on the issue, but we have 600, right? But it's first in, first out. That means we'll start selling the 100, right? Because those ones are the ones that came in first at 380. That means the remaining 500. The 500 will come from 600. That means it's going to be 500. It's going to be at 400, right? This is the 600 I'm talking about from the balance. So the total will be the 600 that has been issued. So for us to find this will be 38,000, and this will be 200,000. Together it would be 238. So the balance now, in the 100 we have sold them. In the 500 we have sold. In the 600 we have sold 500. Remaining 100. That means 100 will be at 400, while the 400 will be at 350. So it will be 40,000 and 140,000. Together 180. Here 500 boxes. We can close that one. Then we'll go to the next. The next is on the 15th of January. The 15th of January, they actually purchased a new consignment of 500 at 140. So on the 15th of January, right, they actually bought 500, right? 500 at 140,000. Per unit, it will give us 280. There's no issue on the same date. That means now the balance is the 100 that is already there at 400. That's 40,000. Then 400 at 350. That's 140,000. And the new consignment of 500 at 280. That is 140. Together, when you sum them up, you're going to find 220,000. You're going to find 1,000 boxes in stock, right? We can close that. Now, let us look at the last activity, which is on 25th January, which they actually sold 400 boxes, right? 400 boxes. So we're saying on 25th January, there was no issue. There was no receipt, but there was issue of 500 boxes, right? 500 boxes. We'll start with the ones that were in their area. So we'll start with the 100. Then the 400 will come from the 300 rather. Because how many are there? They are selling 400, right? So the 300 will come from the 400, this balance right there. So again, 300. That means O will be 400. Those ones that have been issued. The 100 will be issued at 400. That's the unit price. And this one will be issued at 350. So this one will give us 40,000. While the other one should give us what? So the other one should give us 105. To give that 145. Our balance now, right? The 100 has gone. In the 400, 300 has gone. That means only 100 is remaining at 350. And the other 500 is there at 280. So here it's going to be 35,000, right? And this one will be 140,000. Together, the balance will be 175,000. And the boxes will be 600. That's the last transaction. So what happened is this. When they went for the inventory count, they said it here, right? Yarn is sold in a rented premises, and the closing inventory of yarn counted on 30 June was 500 boxes. So after the inventory count, they counted that the boxes are only 500, but on our schedule there are 600 boxes. Have you noticed? We have 600 boxes, but they have counted that there are only 500 boxes, meaning that that is a stock loss. Meaning it might be they have been damaged or they have been stolen. So that one should be treated as a stock loss rather than a cost of production. So the treatment of a cost loss, that means the stock loss is a difference of 500 and 600, which is 100. That one should be treated in the schedule as an issue. So it will be on 30 June. We'll treat that as an issue, right? So we'll say that 100 has been issued. So we're going to say 100, right? Because it's first in, first out, that means we value it at 350, right? Because this is the 100 that we're talking about. The value will be 350, 35,000, right? So the balance will be only the 500 that is remaining. 500 at a value of 28, so it's going to be 140. So this is what is supposed to be done. So you have come up with your schedule. This is your final closing inventory value. So if we are to come up with the statement of profit or loss, right? Statement of profit or loss, we know that we start with sales. So what will be our sales figures? So now the figures of sales, this one will be important now. We have to add up how much they sold all the items during the period. So if you add 250 plus 270 plus 152, we should find 672. So that will be the sales value. So we're going 672,000. Now to find cost of sales or cost of production, we're going to say opening inventory. There was no opening inventory. There will be a dash. What is the purchase? So we're going to see how much did they spend on the purchases. So as to find the purchase figure, we are going to add the figures on the purchases, right? The total cost. So we're going to add 72,000, 152,000, 240,000, 140,000, 140,000. The figure we should find 744,000. So this is the purchases. So we're going to go there and write 144,000. Right? Then the closing stock, we said the closing stock is on the schedule, we said that it's 140. But remember, I said that any stock loss should be treated as an expense. So I'll make this conclusion. Any stock loss should be treated as an expense, or should be expensed, rather than forming part of cost of production. It should not form cost of production. So instead of us putting 140 here, right, we should put the closing inventory that was supposed to be there before the stock loss. It was supposed to be 175. Because the moment we are saying that we are subtracting 140,000, right, we mean that the 35,000 should form part of cost of production. But no, it should not form part of cost of production, but rather it should form part of the expenses. So instead of putting 140 here, we're going to put the cost of inventory before the cost stock loss. So if you subtract that, we should find that the expense is 559,000. So if we subtract, we should find a gross profit of 103,000. This is our gross profit. Now they told us that there's been paid expenses of amounting 23,000. So that's the expenses that were there. So we're gonna put on expenses 23,000. Now the stock loss now can come here now. What is the value of the stock loss? Right? The value of the stock loss, we actually gave it a value. So you come on the entry of the stock loss, the 100, the value that we gave was 35,000. So the 35,000 will be the value that will go there. It should be treated as an expense rather than a cost of production. So we'll put it there. So together, we should find 58,000 rather, as an expense, total expense. And when we subtract, we should find 45,000. So the net profit is 45,000. This is the net profit. So now let us look at the advantages and disadvantage of using FIFO. The advantages is FIFO is the one that is recommended under IS2. When we are looking at accounting, IS2 recommends FIFO. So this is the one that standards in accounting have recommended. So this is the advantage of using FIFO because it is recommended under IS2. The other thing is FIFO produces realistic inventory value. That means closing stock is approximate to the market value. So what this means is, we say that it's first in, first out. So I'm gonna draw so these are different days of purchasing items. So you have our items like this. So what we're saying is, this is, for example, January. We bought the inventories at 50 per unit. On March, we actually bought them at 60. Here, September, 65, and 70 on November. We also bought. Those are the values of the purchase price. That means on December, the date we are preparing our financial statements, right? The value, let's say the value of the goods right now, if we went to buy, is 72, or let's say 71. So because this is first in, first out, if we saw during the year, we'll start with this one, then this one, then this one. For example, the last bunch was not sold. That means the last bunch will be valued at 70, right? While the current market price is 71, it will be closer to the market price. That's why we're saying that we are going to produce realistic, right? Realistic inventory values. We are going to produce realistic inventory values. While the disadvantage is it produces up-to-date cost of production, therefore potential overstate of profit. So now when we are going to look at cost of production, right? We're going to look at those that we have sold now, right? Because if we're going to sell this one, right, we're going to value them at 50, right? We're going to value them at 50. If you compare with the current market price, it's going to be a difference of 21. This figure is outdated. So outdated. These ones also have been sold, and we're going to value them at 60, right? Comparing to the current market price, it's going to be a difference of 11. It is so outdated. If we are gonna, we also sold this one as well. We're gonna value it at 65. There will be a difference of 6. It's so outdated. Have you seen? We are using out-to-date figures to value our cost of production. That's why it's a disadvantage. So if we are gonna use outdated figures, that means we are understating our cost of production. What's the cost? What's the consequence of understating our cost of production? The figure will increase our profit. For example, we are saying that our profit is 200,000, right? Instead of saying that the cost should be valued at 150, we have understated our cost of production to 100, meaning we will show a gross profit of 100 as well. Instead of showing a gross profit of 50, if we are using up-to-date figures, we had to show a profit of 50, meaning that we are oversetting our profits because we have understated our cost of production. So the advantage is that we are having realistic cost inventory values, right? That is the approximate closer to the market value. While the disadvantage is that our cost of production will have out-to-date values, right? Meaning that we will understate our cost of production. Consequently, we are going to overstate our profit. That's the disadvantage. So that's basically what we should know about FIFO. So we'll stop there for the meantime.